Imagine you finally decided to take a stand for your future. You've worked hard, saved every penny, and put $50,000 into a fund promising a 12% yield, the kind of return that makes retirement look easy. For years, you see those monthly checks hit your account, and you feel like you finally won the game. But then, 6 years later, you look at your balance and realize the checks were just pieces of your own house being sold back to you. Your $50,000 is now worth only $41,000. You didn't gain wealth, you just slowly liquidated your future. Hello, I'm here to walk you through the minefield of income investing. After a decade of running the math on every distribution fund in the U.S. market, I've ranked the 10 most popular dividend ETFs from worst to best. Today, you'll discover why most high-yield funds are actually slow-motion return of capital traps. And I'll reveal the only 3 funds that have the structural integrity to truly pay you forever. Before we get to the ranking, you need to understand that choosing an ETF isn't just about picking the highest number on a stock screener. Professional due diligence relies on a framework called ETF, efficiency, tradability, and fit. Efficiency is about your long-term holding costs. Every penny lost to high expense ratios or tracking difference is a penny that isn't compounding for your family. Tradability is your ability to get in and out at a fair price without being taxed by wide bid-ask spreads. And fit? Fit is the most expensive thing to get wrong. It's ensuring the fund's strategy actually aligns with your life goals. Most retail investors ignore these pillars and chase TTM yield, trailing 12-month yield, which is often just a distress signal from a dying company. If you don't understand the how behind the yield, you aren't investing. You're gambling with your retirement. We start our ranking with the most popular trap in the market, QYLD, the Global X NASDAQ 100 Covered Call ETF. It boasts a massive 12% yield, but here's the cold hard truth. It sells at-the-money call options on 100% of its portfolio every single month. This means in a bull market, you forfeit almost all the upside, but in a bear market, you keep all the downside. Since its inception, its share price has eroded from $23 to around $17. It doesn't generate new wealth, it just hands you back your own principal while charging you a 0.60% fee to do it. For a long-term investor, QYLD is like trying to heat your house by burning the wooden beams that hold up the roof. It feels warm for a while, but eventually, the ceiling comes crashing down. In 9th place is KBWD, a fund that tracks high-dividend financial stocks. Many people are lured by its 10% yield, but they miss the hidden cost, a gross expense ratio that can reach a staggering 2.5%. This happens because the fund holds business development companies, BDCs, and mortgage REITs that charge their own management fees on top of the ETF's fee. Furthermore, KBWD is a leveraged bet on a single sector. When interest rates spiked or regional banks like Silicon Valley Bank failed, this fund took massive hits to its principal. Investing here isn't building an income stream, it's putting your entire future in a single high-risk basket that charges you a premium for the privilege of losing your money. The 8th spot goes to SDIV, the Global X Super Dividend ETF. Its strategy sounds great on paper. It buys the 100 highest-yielding stocks in the world. But systematically buying only the highest yields is the cleanest example of a yield trap. A yield often looks high only because the company's stock price has plummeted due to fundamental trouble. In just the last 3 years, SDIV has had 8 dividend decreases and only 4 increases. When you buy SDIV, you are essentially collecting a distress signal rather than a profit. Between currency risks and foreign withholding taxes, the wealth this fund promises almost never actually makes it into your pocket. 7th place belongs to DIV, the US version of the super dividend strategy. While it removes the currency risk of its global brother, the underlying yield trap mechanic remains identical. It concentrates on master limited partnerships, MLPs, and utilities, whose prices have fallen far enough to make their yields look attractive. Historically, its net asset value NAV has trended downward over multi-year windows. If your goal is a stable principal that funds a growing lifestyle, DIV is not the answer. It is a consistent distributor of checks, but those checks are coming at the expense of your foundation. I want to pause here and give you a tool that will save your portfolio. Morningstar research shows there are 3 major predictors of a dividend cut. First is the payout ratio. If a company like Walgreens is paying out 290% of its earnings, nearly 3 times what it actually makes, that dividend is a ghost. Second is the economic moat. Companies with a durable competitive advantage protect their dividends. Those without one, like no-moat retailers, are the first to slash payouts when times get tough. Finally, look at distance to default, a measure of financial health that sniffs out when a company's liabilities are outweighing its assets. Lofty dividend yields are often a sign of fundamental trouble, not a gift from the market. If you don't look forward, you'll be trapped in the past. Moving into the middle of our list, we find XYLD. It uses the same covered call strategy as QYLD, but applies it to the S&P 500. It ranks higher simply because the S&P 500 is structurally less volatile than the Nasdaq, meaning the principal erosion happens more slowly. However, you are still systematically capping your upside on the most important index in the world. In a strong bull market, you are left in the dust, and in a bear market, you still feel the pain. It's a slightly better version of a bad strategy, a slow-motion return of capital disguised as income. In 5th place is the giant JEPI, the JP Morgan Equity Premium Income ETF. With $36 billion in assets, it is the most heavily owned active income product for a reason. It picks lower volatility stocks and uses equity-linked notes, ELNs, to generate an 8% yield. It actually captures about 70 to 80% of the market's upside, a defensible income product. But there is a hidden trap here: taxes. Because of its structure, its distributions are taxed as ordinary income. If you hold JEPI in a taxable brokerage account and you're in a high tax bracket, you might lose over 30% of your yield to the government. It is a workhorse inside an IRA, but in the wrong account, it loses its power. 4th place goes to SPYI, the NEOS S&P 500 High Income ETF. It does what JEPI does, but with a massive structural advantage. It uses Section 1256 contracts, which means 60% of its gains are taxed as long-term capital gains, regardless of how long they were held. For a retiree who has already filled their IRA and is investing in a taxable account, SPYI can provide 3 to 4 percentage points of extra after-tax yield compared to JEPI. It is the best covered call income product on the market for taxable investors. However, it is still young and hasn't been tested through a true multi-year bear market yet. Now we reach the pay forever tier. These are the only 3 funds worth holding for the long haul. Number 3 is DIVO, the Amplify CWP Enhanced Dividend Income ETF. Unlike the mechanical funds, DIVO's manager selectively writes calls on only 20 to 30% of the portfolio. They choose when and how to overwrite based on the quality of individual companies like United Health and Apple. This preserves almost all the equity upside while still providing a 4 to 5% yield. DIVO is for the investor who wants an income stream without sacrificing the long-term compounding that comes from owning quality growers. 2nd place is the legendary SCHD, the Schwab US Dividend Equity ETF. It doesn't use options or tricks. It simply applies a rigorous filter for quality: 10 years of consistent dividend growth, high return on equity, and strong cash flow. Its expense ratio is a near invisible 0.6%. SCHD doesn't just pay a dividend, it pays a dividend that grows every year, protecting your purchasing power against inflation. While it might lag in a tech-crazed market, it is a slow and steady winner that has proven it can endure the test of time. Finally, the champion. The fund that most retail investors reject within 30 seconds because its yield is only 2%, but they are dead wrong. DGRW, the Wisdom Tree U.S. Quality Dividend Growth Fund. DGRW doesn't screen for yield, it screens for profitability. It holds the world's best compounders, names like Microsoft, Apple, and NVIDIA, and weights them by the actual cash dividends they pay. Its 10-year annualized total return is 14.29%, the highest on this entire list. If you invested $100,000 in QYLD, our 10th place fund, in 10 years you might have $197,000. If you put it in DGRW, you'd likely have $381,000. That $184,000 difference is the cost of choosing a yield trap over a wealth builder. DGRW is the ultimate pay-forever fund because it captures the true growth of the global economy. The journey to financial freedom is a marathon of patience, not a sprint for the highest yield. We've seen that the monthly cadence is a feature, but it is never a guarantee of wealth. If you are holding funds that erode your principal just to send you a check, you aren't building a future, you're consuming it. Look at your portfolio today. Ask yourself if your funds are paying you forever or just burning out. Make the switch to quality. Subscribe to stay protected on this journey, and remember, the best time to plant a tree was 20 years ago. The second best time is now. Take action for your future self. I'll see you in the next video.